How could property investors do this? They buy a large 3-bedroom house, pay only $30,000 of their own money, and over 10 years get all of that money back, so the property costs them nothing, and they make £100,000 profit. What's more, they do it passively without dealing with any tenant or property issues. How could they do this with just £30,000? They could do it with a buy-to-let investment mortgage. This video is an educational video that explains how successful investment property buyers use buy-to-let mortgages. There are 8 things you need to know about such mortgages. Before we cover them in detail, let's just list what they are. Firstly, what is a buy-to-let investment mortgage and how is it different from a consumer mortgage on the property that the borrower lives in? Such mortgages are popular, but we also look at why most investors are actually using cash to buy low-cost investment properties rather than such mortgages. 2. How does it work? We will look at the example of the investor above buying a 3-bedroom house, getting all their money back and making £100,000 profit. All this by using under £30,000 of their money. 3. Should investors buy personally or set up a limited company? We explain why company purchase is best for higher rate taxpayers or those buying multiple properties. And we will cover how anyone can easily set up a limited company. Which type of mortgage is best? We explain why interest-only mortgages with initial 5-year fixed rate are currently very popular for buy-to-let. What are the rewards and the risks? And how can the risks of a mortgage be minimized? We cover the 2 main categories of risk and explain how investors reduce these risks to an absolute minimum. We explain how fixing the interest rate, using a good management company, and making a larger deposit all help to reduce risk. Which properties are the best for investment and are ideal for buy-to-let mortgages? We will outline a separate property class video that explains why low-cost freehold houses in the north are best and list the reasons why. 7. What are the lending criteria from mortgage companies? There are criteria for the investor and criteria for the property. 8. What are the actual practical steps in the whole process to buy an investment property with such a mortgage? We cover all the steps in detail and explain how investors can do everything passively by using the right property partner. They do not need to involve themselves with any property or tenant issues and can instead focus on their work or business to generate more income for deposits that enables them to build a portfolio of many properties. By the end of this video, you will fully understand how property investors can be incredibly successful with buy-to-let property investment. So what is a buy-to-let investment mortgage? A buy-to-let mortgage is a secured loan from a bank or other lender on a pure investment property which investors buy for rental income and capital growth. Such mortgages are not regulated by the Financial Conduct Authority or FCA and are different to the mortgages taken on a residential property the borrower lives in or intends to live in, which are regulated. The loan may, for example, be for 70% of the property value and the lender charges interest on the loan, for example 4% of the loan per year, which has to be paid on a monthly basis as the mortgage payment. Now these are just examples. Investors could get a lower interest rate and higher percentage loan, but the criteria may be stricter. Before granting the loan, the lender checks that the investors are eligible and checks that the property is in good condition and suitable value as security for the loan and can generate significantly more rent than the mortgage payment. Now, the aim of this video is educational and not to promote investment mortgages. And it's important to say that most investors buying low-cost houses in the north, in fact, do not use mortgages and pay for their properties in cash. Properties in the north are low cost and are thus affordable even without a mortgage. Some investors may not qualify for mortgages because they are abroad, but there are some other reasons why many investors do not use mortgages even though they qualify. They find properties in the north affordable and they can save up to buy a property every few years, and this builds a portfolio gradually that is 100% debt free. They have enough funds to buy outright, and their prime reason is to supplement income for retirement or other purposes rather than building an investment portfolio. They don't want to take any borrowing risk and want to be debt free. Some don't like the concept of interest for personal or religious reasons. Some find that cash purchases are easy, lower cost and much quicker than buying with a mortgage. This is true. And some buy the property cash if they have the funds, as this is easy and quick, with the knowledge that they could remortgage it later to release funds if they needed them. If they have the funds, then this is a very good option. Investors can be very successful without using mortgages. And of course, they have no interest to pay and none of the borrowing risks or debt associated with a mortgage. So how does it work? Let's make some assumptions and look at an example. We will assume the investment works well and the investor is buying a 3-bed house in the north of England that is valued at £80,000. Now, there will be other costs including 3% stamp duty, solicitors fees, mortgage fees, valuation fee, insurance and other costs. All these extra costs could be as much as £5,000, with government stamp duty being the biggest portion of this. This makes the total price £85,000. Thus, even at 70% loan rate, a property valued at £80,000 can give a loan of £56,000. If the total cost of the property, including all the fees, is over £85,000, then the investor has to find £29,000 cash deposit from his own savings. With low-cost houses, for reasons we will cover later, the mortgage valuation can be below the purchase price, so the deposit needed may be a little higher. Now, on such a property, the net rent, after all costs and expenses, may be around £400 per month. Most investors use 5-year fixed rates of interest and pay the interest only. Even if fixed interest rate is a relatively high 4% and remains at this level, then mortgage payments on such a loan is only £187 per month. The rent will generally increase over the long term, and on average, even after paying the mortgage payment, the investor gets extra rent. On average, with a good property, the rent is more than double the mortgage payment. This net rent itself may pay back the £29,000 cash deposit over about 10 years. So in cash terms, the property would have cost the investor nothing. On top of this, over the next 10 years, if things go well, the property price could almost double from £80,000 to £156,000. If the property was then sold at £156,000, the investor would make a profit of £100,000 after paying the loan of £56,000. Even if the property prices rose by only 60% over the next 10 years, that would still generate over £70,000 profit. Now, the same profit, of course, can be achieved with a cash purchase, and the investment return can actually be even larger as there is no interest to pay. However, the benefits of the mortgage is that the initial funds required per property are much lower. A typical investor focused on buy-to-let investment will work hard in their normal job or business and may continue to accumulate another £30,000. They could do this in 1 or 2 years and then buy another similar property. Over a period of time, they would acquire multiple such properties and build a portfolio of investment properties. Many such investors have a portfolio of around 10 houses each, which over the long term may give them plenty of income for retirement. So that is how it works. Should investors buy personally or set up a limited company? Now, investors will discuss their personal circumstances with a financial advisor to determine which will be best for their particular needs. I can make general comments about what most investors do in different circumstances. Now, in the past, it was almost always better to buy under your personal name. However, we will explain how new tax rules, sometimes called Section 24, mean that it is now better for high rate taxpayers to buy under company name. So, which investors are buying under personal name or joint names? These include investors who are low rate taxpayers. That means income well below £50,000, including their rent, or those that are buying just one to three low cost properties to supplement their income and do not intend to build a very large portfolio of investment properties. In these situations, it may not be worth paying for the costs of setting up and maintaining a limited company. Partners and spouses who are not working could be joint owners and not pay any tax on their 50% portion of rent if their total income is below the personal allowance of £12,570 per year. Buying under your personal name is an easier and quicker process for the investor. As there are many lenders offering such mortgages, the criteria are easier to meet and the interest rates can be up to 1% lower than company mortgages. Many investors who intend to buy multiple properties still buy their first property under personal names. This is particularly important if they do not own a property at all, as it makes it easier for their company to borrow, as then they are seen as an experienced landlord already owning a property. Whilst they are buying their first property, they usually set up the company and get the bank account open so things will be ready for the second and future properties. Here is an example of a low-rate taxpayer buying under personal or company name, a property valued at £100,000 with £75,000 loan. The personal interest rate is 3% and under the company it is 1% higher at 4%. The average net guaranteed rent is 6% in this example. You can see that for the low rate taxpayers, buying under personal name is better. It means that the net profit retained is higher, even though they pay more tax due to the Section 24 rule, where interest is not an allowable expense. The profit is higher because the interest rate is lower on personal mortgages and thus their mortgage payment is lower. Additionally, the £3,000 net profit they make under their personal name belongs to them, whereas with a company purchase, the £2,430 profit shown here belongs to the company, and the investor may need to pay more tax to get all of those funds out. There would also be some company running and maintenance costs. So overall, purchase under personal name is better than company purchase for most low rate taxpayers, especially if buying 1 to 3 low cost investment properties to supplement their income. So which investors are buying under their company name? Now these tend to be high rate taxpayers, which means income over £50,000 per year, or those that will become high rate taxpayers in the future. Also, those that intend to build a large portfolio of properties over time. Company purchase is better for high rate taxpayers because of 3 reasons. Firstly, As a higher rate taxpayer under personal ownership, they would pay 40% or even 45% tax on net rental income rather than the current 19% which a company would pay. Secondly, under personal ownership, the interest they pay cannot be counted as a business expense due to Section 24 rule. Instead, they get a 20% standard rate tax relief on the annual interest they pay. So compared with company ownership, personal owners end up paying extra tax, equivalent to over 20% of the annual interest. Under company purchase, all the interest is counted as a business expense with no tax payable on it. Thirdly, higher rate taxpayers are eventually more likely to end up with larger assets, which are likely to be above the inheritance tax allowance of £325,000 per person. So when they pass away, their children have to pay 40% tax on the assets which are above £325,000 per person. With a company structure, there may be more scope for their accountant to reduce inheritance tax in the future. Here is an example of a high rate taxpayer buying under personal or company name the same example property valued at £100,000. You can see that in this case, buying under company name means that the total tax is over 3 times lower and the profit retained is 35% higher. This is still the case even though the mortgage interest rate on the company mortgages are around 1% higher. The gap between personal and company mortgage rates is falling as more lenders offer company mortgages. So for higher rate taxpayers and serious investors looking to build large portfolios, it is best to set up a UK limited company. So how do investors set up a UK company? It can be done directly with Companies House website online or with company formation agents. Many investors use a low-cost local accountant to do this. Property specialist companies that provide a total investment solution can also help investors set up this as part of their overall package. The process is to decide on a name that is available, decide on the shareholders. These are normally husband and wife, but can be other partners and family members too. Directors are normally the main shareholders, for example, husband and wife. The company activity code or SIC code is normally 68209, which is suitable for long-term buy-to-let investment. Some investors have 2 SIC codes in their company and also include SIC code 68100, which is for buying and selling property. The basic business plan should be to set up the company specifically for the purpose of buying investment property and not do other non-property business. Then borrowing becomes easier. Sometimes such a company is called a special purpose vehicle or SPV because it is only set up for property business. Once the company is set up, the company documents can be used to open a bank account. Using the direct online banks, and there are many of those, might be quicker and easier than using the traditional high street banks. Now, most investors will inject their money, for example £30,000, into the company bank account as director's loan. This means that later, when company makes profits, they can take that money out of the company without paying any tax. They can just take parts of their loan as and when they need it. Now, normally all the rental income is left in the company to accumulate, and minimum money is taken out of the company as dividends. Most investors take out just £2,000 dividend from the company each year, as this is tax-free, but they usually put this back in as director's loan. They continue saving and inject more money into the company as director's loan, and when the company builds up another £30,000 worth of savings, it is ready to buy another buy-to-let investment property. What are the rewards and the risks of buy-to-let mortgages? You can see from the example at the beginning of this video that when things work well, the investor makes an initial investment of £29,000, but gets this all back in net rent over about 10 years, even after paying all the mortgage payments. So the property costs them nothing in cash terms, and they make a healthy profit of £100,000 due to capital growth over the long term. Now, if they were to acquire multiple properties and build a large portfolio, then the rewards are immense. When you look at these figures, you can see how so many buy-to-let investors have made vast fortunes over the past 40 years, even after taking into account periods of recession. But there are risks. What are they? Well, there are two main categories of risks. The first risks relate to the economy, in particular interest rates and property prices. Interest rates could increase substantially, making the mortgage payments high. If the increases were very high, these could be more than the net rent. This would mean that the investor may have to use some of their own funds to pay towards the mortgage payment. The rent itself may not be enough. Property prices may not increase as per the historical levels in the past. On average, over the last 70 years, house prices have doubled almost every 11 years. In a recession, property prices can fall, although they normally increase after the recession is over. If they fall in a recession and the investor has to resell the property sooner for any reason, whilst the price is low, for example, if the mortgage payment is too high and not affordable, then they would make a loss. The worst case scenario is that they could lose their property if they do not make the mortgage payments on it, and this would also affect their credit rating. Now, this type of risk can be reduced by taking a lower loan on the property and thus paying a larger deposit. This has three benefits. Firstly, the mortgage payments are lower because the loan is smaller and are thus easily covered by the net rent, and investors do not have to resell if interest rates rise, enabling them to ride out the recession. A larger deposit may also enable them to get a lower interest rate, thus further reducing their mortgage payment. Borrowing less on each property keeps the investor's property portfolio healthy. This is important because once they have more than 3 buy-to-let mortgage properties, they are classed as a portfolio landlord, and further lending criteria are stricter. They cannot easily get more mortgage properties if their existing portfolio has a high percentage of loan on it. Now, many investors are focused on getting the maximum loan and paying the minimum deposit. This is not always the wisest strategy. The sweet spot for profitability, lower risk, and a healthy large portfolio may in fact be a smaller loan with a larger deposit on each property. Now, investors can also reduce the risk by fixing the mortgage payment for a long time, for example 5 years or even 10 years. They pay a slightly higher rate, but their mortgage payment will not increase during the 5 years. At the end of the 5 years, they can negotiate another fixed rate with the same lender, or switch to another lender that offers a better 5-year fixed rate. They can keep doing this to ensure that they get the lowest interest rates. The mortgage advisor helps them in this process. The second type of risk relates to the property itself, and this could be minimized by selecting the right property management partner. The example at the beginning assumed that the property delivered a consistent net rent after all expenses. This may not happen for a number of reasons, especially if the investor is not local to the property. The rent may be lower because the property is vacant. The tenant does not pay or the market rents fall. The property costs themselves may be higher than expected because of a number of reasons, because repairs and maintenance costs are higher, management, compliance and reletting costs are higher, or there are unexpected costs such as tenant eviction costs. Now, with lower rents and higher costs, the net rent is reduced and they may not be able to make the mortgage payments. In such a case, they may get so involved with property issues that their work, business or health also suffers. Now, as I mentioned, these property related risks can be minimized by selecting the right property partner. There are companies that provide a total investment solution with a net guaranteed rent system. They take care of all of the property costs and issues relating to the property so that owners can be true passive investors. Overall, over the long term, such investments can deliver better and consistent net rent with no hassle for investors. This also allows them to focus on their work or business to continue to generate savings to buy more properties rather than dealing with tenant or property issues. Which type of mortgage is best? Now, the mortgage advisor will normally advise investors on the best mortgage for their particular circumstances. I can tell you what most buy-to-let investors do in different circumstances. Now, mortgages can be standard variable, fixed or tracker. Each mortgage lender will have their own underlying rate, which its mortgages default to, called the standard variable rate, which is usually a high rate and changes with general interest rates. However, for a fixed period of 2, 5 or 10 years, the rate can be fixed. This is called a fixed rate mortgage. Alternatively, for a period or a long term, it can exactly track a rate such as the Bank of England base rate. For example, that mortgage rate may be always 2% above the Bank of England base rate. This is called a tracker mortgage. Now, before the fixed period ends, the investors, before they go on to the standard variable rate, they have the right to renegotiate with the same lender for another fixed period. This is called product transfer and is easy to do. And they could get another fixed rate for 2 or 5 years. If the lender does not offer a good rate, with the advice of a mortgage broker, the investors can switch to another lender. Mortgages can also be interest only, where the interest only is paid back. With repayment mortgages, the original loan is also gradually paid as well as the interest. Paying the interest only is popular with investment mortgages, as then the monthly payments are lower and more of the rent can be used to save for a deposit to buy another property. The original loan remains the same, but as time passes, it becomes a smaller percentage of the property value, which gradually increases. Over a period of, say, 25 years, the original loan may become less than 20% of the property price. In the meantime, the investor may have acquired multiple properties, and if they wanted, 1 or 2 of these could be sold off to pay off all the loans. For the term of the loan, a popular duration is 25 years, but can be shorter or longer. These days, investors are looking for certainty and lower risk. Thus, the most popular mortgage is interest only, typically fixed for 5 years on a 25-year term. They typically renegotiate this to another fixed rate before the 5 years end. Now, which properties are best for investment? There is a separate video located at the top of our website, that's findukproperty.com, that covers this in detail. But in summary, the best properties for investment are freehold type houses, not leasehold apartments, which have service charges and other costs. Lower cost, between 70 to 120,000, as rental yields are higher. located in the north, as properties are affordable with higher yields and good future potential growth. I won't go into this in detail here, but the main video on our website explains clearly the reasons why this is the case. It also explains that when it comes to buying and managing an investment property, especially for passive investors who may not be local, the facilitated buying process with an agreement of reservation in advance that stipulates the entire process makes the buying easier and quicker. And the net guaranteed rent system provides certainty of income and reduces risks related to rent and property issues. It takes away all of the tenant and property liabilities from the investor. What criteria do borrowers need to meet? Now, different lenders have different criteria. Although there may be exceptions, in general, investors need to prove they meet these popular criteria with most lenders. They need to be UK resident, have an income of at least £25,000 per year, have a good credit rating, and have sufficient deposit, for example £30,000 savings for a good low cost house. With regards to the property, it needs to be standard construction, of sufficient value, and immediately able to deliver rent that is around 25% to 50% higher than the mortgage payment. It also needs to be in a good rentable condition before the mortgage can be approved. A buy-to-let mortgage is not possible on a property that is not immediately rentable. If it needs significant renovation work or is not compliant with rental regulations, the mortgage will be rejected. Many lenders do not lend on properties that are less than, say, 75 to 80,000. So selecting slightly higher value properties is best when you're going for a mortgage. Remember, you cannot get a buy-to-let mortgage on the property you intend to live in. These mortgages are only for investors and can only be used on investment properties that are purchased for renting out. Typically, a good mortgage advisor will do a fact check to look at the investor's circumstances and also ask them to provide evidence that they meet the criteria. Then they look at all the possible lenders and work out the best overall deal for investors, their personal circumstances, and also for the type of property that they are buying. Now, what are the practical steps in the process? How do investors get started? I'm going to look at the whole process of getting a total property investment solution that involves a buy-to-let mortgage and is ideal for passive investors. Buying with a mortgage takes twice as long compared with buying cash, and there is more uncertainty. So if you have funds available, then buying cash and mortgaging later is also a good option. Now, different property companies have slightly different processes. We're going to cover these 8 steps, and this is a typical process to acquire an investment property using a buy-to-let mortgage. Step 1. The investor have an initial Zoom meeting. Prior to this, they watch this video and the main property video that is located at the top of our website, and they make a list of questions. At the meeting, they discuss their circumstances, their long-term plans, and all the possible options. Are they just looking to buy 1 or 2 houses, or to develop a large portfolio over a long time? Then consider how the property will be owned, personally and by whom, or via a company, in which case who will be the shareholders and directors. If funds are available, also consider the pros and cons of buying cash up front and then mortgaging later. Depending on their savings for their first property, they can work out a provisional deal on price and deposit. For example, a 3-bedroom house for £84,000 with total cash funds of around £30,000. Step 2. The investor provides information. An example checklist may be their ID, for example, passport copy and driving license, a bank statement ideally showing deposit of around £30,000, 3 months of bank statements showing their main income and outgoings, evidence of income, this may be 3 months salary slips or P60 form, or for business owners their personal tax computations and overviews for the past 2 years, and a personal credit report which can be obtained free of charge online. Step 3. Investor provisionally agrees a property target price, expected rent, and overall terms and guarantees of any possible purchase. This could be in the form of a reservation agreement, and there may be a payment of a small reservation fee which would be refunded if the mortgage was not approved. This makes the process easy and removes uncertainty. Step 4. The mortgage broker will do what we call a fact find to assess the circumstances of the investor and make an application in principle and get approval for a provisional mortgage offer in principle. Step 5. The investor selects the specific property depending on their budget and preferences. If the property comes with repairs and maintenance guarantees and guaranteed rent, then the selection process is easier. Section 4 of the main video explains how the process works. Step 6. Make the final mortgage application. The final application is made and the mortgage lender will arrange to assess the property and do the property valuation. Now, there are 3 common reasons why the valuation for buy-to-let mortgages can be lower than the price paid, especially for low-cost older houses that are recently renovated. Firstly, buy-to-let valuations on older houses do tend to be marked down a little by lenders. Secondly, the way buy-to-let valuations work is that they aim to be similar to other houses selling at that time in that location and are thus linked to recent sold prices. Now, with low-cost properties, the renovation state of the property has a big impact on the actual selling price. Many older houses selling in the same area may be in the unrenovated condition and will thus have been sold at lower prices. This will influence the valuation. Even if the property the investor is buying has had a full renovation and had the EPC upgraded to grade C or above, this is not always fully taken into account and the valuation may thus be lower. Thirdly, the valuation is just for the house. Even if the investor is buying a total guaranteed investment package with all repairs, maintenance and further re-renovations fully covered for the long term, the valuation does not take this into account and values the house only and is thus lower. The reason why it is important to understand this is that it allows the investors and the advisors to plan better and build some flexibility into the final cash requirement if the loan offered by the lender is slightly smaller, and thus ensure a successful outcome. Step 7. Finalize the property deal and agree the final loan and deposit. For the reasons listed above, the loan amount may be lower than expected and the deposit may be slightly higher. This is no bad thing, providing this is affordable, as the monthly mortgage payments will also be slightly lower. Step 8. Purchase completion. The investor makes the final deposit payment. The solicitors do the property searches and finalize the mortgage contract and paperwork. They obtain the mortgage funds directly from the mortgage lender and complete the purchase. They provide a completion summary. The investor becomes the legal owner on the completion date and starts getting rental income from the agreed date, normally 1 month after purchase completion. In summary, you now know the 8 main facts about investment mortgages and the 8 practical steps of how investors buy a low-cost investment property with such a mortgage. The rewards are obvious, but the key take from this property class is that in order to reduce the risks and build a healthy portfolio, investors should take a slightly lower loan on each property and use a property management partner that covers everything, thus enabling them to be true passive investors. If you meet the criteria and want to invest in property passively with the help of a good property management company that does everything for you, then I'm happy to have a Zoom meeting to understand your circumstances and answer all of your questions. Please contact us to book a slot or complete any inquiry form on our website and request a meeting. One of our sales team will assess your requirements and arrange the meeting. Before the meeting, I would ask investors to also watch the main property video located at the top of our website and make a list of questions. Although I am a director of a property sales and management company, I will not try to sell you anything. We will just provide information, explain the process, and answer your questions directly. So don't be afraid to ask anything. A link to this main property video is also shown at the end of this video. Thank you. Please watch the main property video here. It explains everything you need to know about buying investment property in the UK. Or alternatively, you can watch one of the BBC TV videos on our family business here.